So let's bring in here someone who's prepared to talk about this change and how it will affect public companies and their investors. Gabriel Radzyminski is the founder and chief investment officer at Shandon Capital, an activist funds management business, and he joins me now. Gabriel, many thanks for your time. The government says, look, not many people are going to be affected by this, and if they are affected, they're older, wealthier people. Is that the reality?
No, I think that's one of the misdirections that's occurring in this debate, is that franking is something that's available to all Australians. Everyone who has a super account can benefit from franking, as well as individual investors who invest their own money. And I think one of the things that is happening to try and minimise the public outrage of what's happening is to say it's only old, rich retirees who benefit. Everyone has a stake in this debate.
Okay, so let's explain why everybody's affected. Because if you have shares in your superannuation fund, big or small, doesn't matter whether you're in a, what sort of fund it is. The reality is that the company pays tax. It then pays a dividend to which a tax credit is attached.
Correct.
It's in your superannuation fund. Your super fund pays tax at 15%.
Correct.
But because the company tax rate is 30%, it then gets a tax credit which boosts your superannuation return.
So for young people in accumulation phase, my son, 18-year-old, he'll start working when he finishes uni. He'll start accumulating, and if he's invested in options that offer fully franked dividends, he will get a refund of that excess franking for that 15%, that effectively 50% of the tax rate, which helps build the balance over time. Every Australian, young and old, has a stake in the debate. Companies have a stake in the debate because the proposals, particularly with respect to off-market share buybacks, hampers a company's ability to manage their capital.
Okay, so just explain to me and to people the importance of the share buybacks and the reality as to whether they are on-market or off-market. Is there a fundamental difference in the way in which they're treated?
Look, there is. So an off-market share buyback is where a company simply instructs a broker to buy shares on market.
Okay, because they've got surplus capital, and so they decide not to pay it as a dividend. They decide instead to buy back their own shares.
Could be, or it could be a combination of both. I mean, a lot of companies, I think, do a lot of different things to manage their capital. They'll buy back shares, they'll pay dividends, they might raise debt. There's a whole raft of things that they're allowed to do, and they do.
And what we're talking about here is the biggest companies in Australia. All of the big companies in Australia, all of them do this.
Yeah, they all do this. I mean, it's capital management 101. That's what that's one of the key responsibilities of the board, is to manage the capital of the
Okay, so let's go through this. The most popularly held companies in Australia are the Commonwealth Bank, Telstra, BHP. They all do it.
They all do it from time to time. CBA, Westpac, BHP have done off-market buybacks.
Right. Now, explain the difference there.
So an off-market buyback typically occurs when a company wants to buy back shares in a slightly different way. And what they do is they undertake what's called a selective buyback. So they could do equal access. They could buy, if you own 10 shares, they could buy one share off everyone. That's a 10% buyback from everyone. More often than not, what they'll do is do a selective buyback, because they understand that shareholders each have different imperatives, different tax profiles, different needs at different times. Mm-hmm. So what they do is they decide that there might be an opportunity to do a selective buyback. It's put to shareholders. Shareholders who don't want to participate in the buyback are the ones who have to vote to approve it. Mm-hmm. Conflict of interest. You don't want the people who benefit to approve it for themselves.
Sure.
So there's a lot of checks and balances in how these things occur. And then if it's approved, the company then offers investors, shareholders, the opportunity to sell their shares back to the company via a tender, and they typically involve a component of fully franked dividends.
Now this is the key here, because this is the thing that changes as a result of the government legislation. If you do a buyback, the government is now wanting to say you can't issue those franking credits to those investors.
Yes. Effectively, what the government is trying to do is prevent companies from using their capital and maintaining the nexus with franking.
Yes.
So it also looks to restrict, as it stands today, the proposal looks to restrict the ability of a company to raise capital and to then pay a dividend on those new shares, because they'll argue that the company is raising money to pay the dividend. Now, sometimes that can be true, but at the end of the day, they're simply applying long-held rules of franking to manage their capital.
Yes. So the other aspect of this is also that whose franking credits are they? because this is one of the important aspects of this. Once the company has paid its tax, dividend imputation was to avoid the double taxation.
Correct.
And so as a result, technically any of those dividend imputation credits are the shareholders.
Well, I suspect the tax office considers that they belong to them.
See, there's the problem, isn't it? Yeah. There is the fundamental problem.
That's the nub of it.
Right. So, but surely, if the philosophy of Paul Keating all the way back sensibly was to create a generation of shareholders, was to actually overcome the concept of double taxation. But as you point out, the tax office says, well, we wouldn't mind a bit of that.
I think, look, part of the problem in what's happening, my view of the problem that we're facing at the moment is there's a desperate need for tax reform and tax repair. And there's an unwillingness to confront the issue head on and be open and transparent about it. So, for example, the changes to the super balances, in a roundabout way, that's actually an attack on franking.
How do you get that?
Because so keep in mind, for most companies, particularly large listed companies, the corporate tax rate is 30%.
Yep.
The proposals that is before the Parliament is to increase the tax above the the cap that they've got. I've lost track of where the cap is.
Which is, that's right. So,
yeah, but $3 million.
$3 million.
Above that, they're proposing to charge 30%.
Yes.
Up from 15%. That 30% equals the company tax rate, which means that you will no longer get a refund of those excess franking credits.
Right. So in other words, because in the past, not only this was the attack that Bill Shorten tried to have, of course,
Correct.
was to get rid of those excess franking credits so you wouldn't get cash back.
Correct.
You're saying in those super funds, because the rate goes to 30%, wealthier Australians no longer get a refund back.
Correct.
Because their tax rate is lower.
Correct.
So it's exactly the same thing. Can I just ask another question? A lot of people would say that this will change the way in which companies operate in terms of raising capital in the future, might even suppress the ability for companies to raise capital. Is that true or not?
Look, we don't know what the future, we don't exactly know how it will happen, but anything that impinges on a company's ability to manage its capital has to have an impact. Unintended consequences are very difficult to predict, but the reality is they will occur. Recently, Challenger issued a new hybrid security. Banks and financial services firms have been using hybrid securities to great success in recent years. And what they do is they typically offer a headline yield, but which is actually comprised of the cash dividend plus the franking credits. Mm. And in the fine print of the prospectuses, they will always say, franking credit law may change, and if they change, we will make up the difference in cash. But what's happened, I believe this has happened recently, is that the banks made clear to the Treasury and the government that was an important aspect of their capital management. And we've heard on the grapevine that the whisper is that that's all right, banks will be allowed to continue using franking on those securities, when reading the current proposal of the Treasury drafts would suggest that if you raise new capital today and then pay dividends, that should... So you can see that the proposal seems to have been worked out on the go.
Yep.
And now they're realising that there are problems each and every step of the way.
Gabriel Radzyminski from Shandon Capital, many thanks for your explanation.
Thanks for having me.
Appreciate it very much for your time.
Thank you.